Level Business Study, 9609, Chapter 6. So a cost is basically an expense because you incur inside the business at the present time. And we have two types of costs. We have fixed costs and we have variable costs. Fixed costs are those costs which do not change as the output changes. An example of fixed cost is rent. An example, well, variable cost plus fixed cost, and we'll get total cost. Now, variable costs are those costs that can change when the output changes. An example is the electricity bill. Because literally, if we produce more, maybe let's say, clothes, then automatically the cost of selling the clothes will increase. Now, my brothers and sisters, there are key formulas that you must use the exam. We have the break-even point formula in both units and sales. We also have the margin for safety and the contributional margin. The formula for contributional margin is going to be sales minus variable costs. Now the formula for break-even points in units is going to be fixed costs divided by the contributional margin, which is sales minus variable costs. Okay, now what is the margin of safety? So basically, the margin of safety is basically sales minus break-even point. What is budgeting? Budgeting is basically fixing a limit on the business plan. Now, what's the advantages and disadvantages of budgeting? Firstly, budgeting, it can be time consuming and sometimes it can be inaccurate. But on the other hand, it can be very useful in motivation and it can reduce the amount of expenditures by the business. Now let's talk about variance. So what is variance? We have favorable variance and unfavorable variance. Favorable variance is basically the good variance. So it's when the actual profit is greater than the budget. But then we have unfavorable or adverse, same thing. Now what this means is that the actual profit is less budget. Now what is cash inflow and cash outflow? Cash inflow is the money that comes into the business. Cash outflow is the money that goes out of the business. We also have working capital. So working capital is basically the current assets minus the current liabilities. One more thing I forgot to mention before we finish this video is direct costs, indirect costs, and the actual difference. What is this plan? Direct cost is that cost that can be basically to one specific product. And now indirect cost is the cost will not be really allotted. Or the overhead. Example of direct cost. Now what is break-even point? Break-even point in the business where the total revenue equals the total cost. That basically means if the cost increases just a little bit, then we'll be in loss. But if the profit increases just a little bit, then we'll already be in profit. Therefore, it's the point in the business where no profit is generated.
So if this video helps you and you think it might help somebody else,
Feel free to share, like, and subscribe. Thanks for watching. See you in the next video.